There are many different types of insurance policies, from historic GL policies to cover legacy long-tail claims, directors and officers policies, and current GL policies, and that's just a few. As different as they may all be, they have one thing in common. There will come a point in time when the policyholder is informed by the primary carrier that their coverage is exhausted. In order to get the next layer of coverage to pay, the burden of proof is on the policyholder to show that those policies are truly exhausted. While it may sound easy, it's not, and the policyholder often finds themselves in a battle that can be very time-consuming and costly. There are many different ways to prove exhaustion. Oftentimes, the primary insurer will provide a loss run to the policyholder. I've seen some very detailed loss runs, but just as often, I've seen some very messy and incomplete ones. In these cases, the policyholder can turn to historic claims data. They can compare the value of those claims to the value of the insurance coverage in question. It sounds easy, but often the records are messy and incomplete. But with the right expertise, the data can be reconstructed. Another alternative is to use records that help show and prove that the payments were actually made to the underlying claimants. The use of claims data and payment records is often coupled with an insurance allocation to show that spreading the losses to the various policies do in fact prove that the primary coverage is exhausted. In my work, I find the best way to prove underlying exhaustion is to use a combination of these sources. That leaves us with a strong, undeniable argument should it be needed in a courtroom or in settlement negotiations.